Well, thank you all for attending today's webinar. We've got a great one for you, as always. Hopefully everyone's off to a great start to 2025. And, today's topic, I think, is, very timely, considering there's been a lot of changes over the past several years regarding retirement accounts and uh, 529 plans and what happens when people pass away with their beneficiaries regarding their IRAs. And a lot of that's changed via legislation. We had the Secure Act 1.0, and then we've had the Secure Act 2.0. And I'm going to cover, everything that's been changing over these period of this period of time, because again, the rules are changing. As much as we like to plan, we also know that we do have to plan for change, and the rules just don't stay the same throughout the whole time. My name is Matt Wilson. I am the President and Chief Investment Officer here at Keen Wealth Advisors, and we are a fiduciary financial planning and investment management firm headquartered in Overland Park, Kansas. And we help people make that transition from being dependent on a job and working to independent and retired. And today, hopefully, you learn a little bit about some of the rule changes. There might be a thing or two that you didn't realize changed, and now you have a better idea of how that's all going to work. You can find, we do these webinars monthly, and we publish a blog and podcast weekly as well. And you can find those on our website, keenwealthadvisors.com, under the Retirement Resources tab. And we also have Mr. Keen. He's a best-selling author, Keen on Retirement, Engineering the Second Half of Your Life. And if you'd like a copy of that, please, send us an email, reply to any of the emails that that we send you, or you can send me an email directly, mwilson@keenwealthadvisors.com, and happy to get a book sent out to you. And lastly, we have a YouTube channel. We've been publishing videos. We publish the video version of our podcast on our YouTube channel now. Also, just other timely topics, short clips. So, encourage all of you, if you have not subscribed, go to our YouTube channel and subscribe. Okay, let's get into today's topic. So, Secure Act 2.0, but also want to discuss some of the changes with Social Security and Medicare. There's not any significant changes besides just the standard annual changes that we've come to expect with cost of living, earnings tests regarding Social Security, how Social Security taxes work, touch a little bit on the situation with the new administration and their thoughts around no taxes on Social Security. And then, of course, Medicare and the premiums for 2025. So yes, all checks in 2025 are going up. You should have, if you're on Social Security, you would have received a notification sometime towards in Q4 of 2024 regarding the changes in 2025. The amount for 2025 was an increase of 2.5%, the cost of living adjustment, or COLA, as it's abbreviated. And you can see on this screen, I've just got some, benefit amounts and how much that would be based on that cost of living adjustment. But if you look back at history, it kind of puts this in perspective too, because, it changes every single year. Going back to 1990, you actually can go to the Social Security Administration's website and you can see all the cost of living changes that they've made once they instituted a automatic cost of living increase. And they use a calculation. It's published by the government. It's the CPI W, I believe, which is the Consumer Price Index for a working person. So it's a basket of goods and services, and they track the prices on that. And that's how they determine the cost of living increase every year. But yeah, looking back, you can see in the 90s, 2000s, and then kind of post 2000, after we had the global financial crisis there, the inflation was much lower for a period of time, and there was no cost of living increases, or very, and then very little ones up until about 2022 post-COVID, where we've seen some significant increases. I mean, some of the highest ones we've seen in decades. Inflation is slowly coming down. Prices aren't necessarily coming down, but the rate of increase is slowing. And that's what inflation is. Its prices just increase, just how quickly are they increasing? The earnings test, so this applies to people who are working and under their full retirement age, and then also want to or are receiving benefits. So if you're considering turning on Social Security while you're working and you're under your full retirement age, which that is the age, on your statement, if you get your statement in the mail, if you log in, they publish this, it says your full retirement age. And that's the age that you're eligible for 100% of your benefits. And it's, you can claim it as early as 62, you can delay it up to age 70, but it's 66 and 10 months, I believe, is the full retirement age for people that are eligible this year, and then next year it's going to increase to 67, and that is the current maximum full retirement age for everybody. No one's full retirement age is older than age 67 currently. So if you are, let's say you're 63 this year, and you want to turn on your Social Security benefit, but you're also still working. Well, they have this number, they call it the earnings test, and it's in 2025, 23,400, up from last year. And the way this works is that $1 in benefits would be, it says here withheld, but it would be taxed or penalized for every $2 earned over 23,400. Okay, so what does that mean? Well, if you're 63, turn on Social Security, working, and you earn 33,000, you're roughly $10,000 over the threshold. Well, if you take the 10,000 divided by 2, you would have a $5,000 tax, because they would determine this. They'd figure it out when you file your taxes, and they tell you that you owe Social Security $5,000 back because you went over the earnings threshold. Now, if this is a situation that applies to you, and if this happened, I would encourage you to reach out to the Social Security Administration, because they do work with people. I mean, you're still going to have to pay the money back, but they might, instead of just having to write a check for it, they could withhold a little bit out of your future checks to reduce that amount. A lot of, several different ways to take care of that. And then the year that you reach your full retirement age, they have a different calculation. Prior to, let's say your birthday is July 1st, so the first 6 months of the year you're not at your full retirement age. This is the earnings test, so it's much higher, 62,160. But then once you reach your full retirement age, so July 1, you can earn as much as you want in the last 6 months of the year and not be worried about it. So just how that works when you're looking at Social Security while you're still working. And when I say working, what that means is it's earned income. So that is W-2 income, self-employment income. Does not apply to IRA distributions, pensions, dividends, interest. Those aren't considered earned income by the IRS from the definition of that. Let's talk about payroll taxes too. So this is how Social Security is funded. And the maximum earnings that are subject to the payroll tax, as it's called, or FICA tax, is $176,000 in 2025, and that's per person. So if you're, married and you have 2 wage earners, each person is subject to this $176,000. If you earn more than this, you may notice that towards the end of the year or whenever you cross this threshold, your paychecks go up, and that's because the payroll tax is reduced. There's 2 components to the payroll tax. It's made up of Medicare and Social Security. So it's 6.2% applies to Social Security, and that's what that $176,000 threshold is applying to. So once you reach that, the 6.2% drops off. Medicare does not have a cap, so it's 1.45% on all earnings, and that's the combined of those two is what comes out of your paycheck as part of the payroll tax. And if you're self-employed, you have to pay both sides of this. For folks that are self-employed, you're probably aware of this. You've had to deal with this for years. Now let's talk about how Social Security is taxed. So this is current law. When you're receiving Social Security, everyone receives a portion of their Social Security tax-free. And the way this is how it's determined how much of your Social Security is taxable is income. And they have a special formula, and it's called the provisional income formula, which is made up of your adjusted gross income plus 1/2 your Social Security benefit plus all of your tax exempt interest. So tax exempt interest is income typically received from municipal bonds, and those are it only applies for those types of investments that are outside of retirement accounts or tax deferred accounts. So for many folks, not necessarily as common, but they do add that back in, because if you do have a large taxable account or brokerage account that is kicking off a lot of tax-free interest, they do say, well, we're going to factor that in to determine how much your Social Security is taxed. Married filing jointly, that's here at the top. So if your provisional income calculation is under $32,000, you receive all of your Social Security tax-free. And that's for, this is a combined calculation. So this looks at your, again, joint tax return, because it's married filing jointly. If you're single, that threshold is $25,000. And then if you're married filing separately, they just say it doesn't matter, you're subject to the maximum. And the way that works, so you see here in married filing jointly, as your income crosses over $32,000 but is under $44,000, up to 50% of your Social Security counts as income on your tax return and then flows through the tax brackets. And then once you hit over 44,000, that becomes 85% of your Social Security counts as income. 15% of it is tax-free. So everyone gets that. Everyone gets 15% of their Social Security tax-free. And then if your income is lower, according to this provisional income calculation, then you might have more of your Social Security tax-free. So you can kind of see where those numbers lie. So when it comes to, we received some questions from some of the people on today's webinar around, well, what's our thoughts on Social Security being tax-free? That was something that the new administration discussed during their campaign, and I think that's going to be a difficult thing to pass, primarily because there's already an issue with the funding of the Social Security trust funds on a long-term basis. So when that payroll tax is withheld from your paycheck, so that's from all the entire workforce in the United States, when they're receiving their W-2s or their income each pay period, they're having the payroll tax withheld. If you're self-employed, you got to pay it throughout the year, and that goes into the Social Security trust funds. And then the trust funds have built up over time because we've had more people paying in as workers than we've had distributions coming out to the beneficiaries that are on Social Security. Well, that's going to flip, and latest data that I've seen is that's supposed to happen in 2034, where the trust funds are depleted, and then now there's a shortfall. And the estimate is that about 75% of the future distributions would be covered through the payroll tax. So the government would need to do something to make sure that everyone receives their Social Security check. So that would probably mean higher taxes. Or they could just pass a law and say, we're going to cut it, across the board, which I don't think that's likely at all. So if they eliminate the tax on Social Security, because the tax on Social Security, this amount, this formula determines how much Social Security is taxable as income, and then that tax that's applied to your Social Security is then put back into those Social Security trust funds. So this would reduce even more so the situation. It would make the trust funds run out even sooner. I think some estimates that I've seen is about 2030. So that's why I think it's less likely to happen, just because that kind of just perpetuates the problem a little bit quicker. However, I do think there could be some changes, and this could be this formula could be something that changes. These numbers, the provisional income thresholds or brackets here, have not changed. It's been this way for quite some time. I mean, ever since I've been looking at this for the past 23 years, this has been the same. And so it has not accounted for inflation, so it's hitting people, more and more. Whereas when it first was put into place, which is in the early 80s, this probably didn't apply to as many people. So something that I think they could adjust. Other solutions would be increasing the payroll tax, lifting the caps. I think they're more inclined to change the benefits for the current workforce. So the people who aren't on Social Security currently, and push out maybe full retirement age for the younger demographics, a lot of things like that I think would be easier to pass from a legislation standpoint. Some minor changes to Medicare in 2025. So if you're on Medicare, you're eligible at age 65, and there is several parts to Medicare. Part A, which is your hospital insurance, and that is premium free. You've paid for that via the payroll tax. They don't charge a premium for that. There's Part B, which covers 80% of your medical coverage, and that costs $185 a month for every single person. However, if your income is higher, then you might pay more for your Part B. And I'll show you how that works. Then there's Part D, which is the drug coverage. That also is, there's the minimum amount that everyone pays, and then that increases if your income is high. So that's how it works. And then you have different ways that you can, since this covers 80% of your medical insurance, then there's policies that cover the other 20% via original Medicare, traditional Medicare, or Medicare Advantage plans. Those are a couple of different ways. And we do a whole webinar on Medicare too, to kind of go through how all that works. There's a hold harmless provision, which what this means is that if the increase in Social Security is not sufficient to cover the increase in Medicare, that they don't reduce your Social Security because Medicare went up higher. Meaning, let's say your Social Security check went up $10, but your Medicare premium, now this is prior to IRMAA, so this is just the base, applies to the base Part B and Part D, was supposed to go up, $12. Well, they would only increase it up to the 10. They wouldn't increase it past that. So that's what the hold harmless provision means. This is more common. We see this when the cost of living increases for Social Security are very low. In some years, on that previous slide, you might have seen that they were zero. Well, there was no increase in Social Security, but Medicare costs went up. But if for those in those hold harmless provisions, your Social Security check didn't go backwards. So what that essentially what this means. Now, what is this IRMAA? This is the surcharge. It stands for Income Related Monthly Adjustment Amount. And this is, essentially a tax that applies to individuals that are on Medicare. So this is a per person, increase in cost if you're a different kind of formula called modified adjusted gross income is over $106,000 if you're single, $212,000 if you're married filing jointly. And the modified adjusted gross income stands for, that's your AGI plus tax exempt interest, so similar to the provisional income. And it's based on your modified adjusted gross income from 2 years prior. So your 2025 Medicare premium is based on your 2023 tax return. you're married filing jointly and your 2023 tax return is under 212,000, you just pay the base. You don't pay any extra. If your modified adjusted gross income is above that, then you're subject to these IRMAA surcharges. And then they increase as the amount of income increases as well. And you can appeal it. So, this is the most common appeal that we see is someone was working in 2023 and they retired in 2024. Medicare, they're on Medicare, Social Security 2025, taking distributions from IRAs, all the above. Well, IRS or the administration looks at your 2023 tax return. Well, if you're working, you can submit this appeal, because if your 2023 tax return and your modified adjusted gross income is higher than this, you could say, I was working at the time, I'm now retired. My current income for the year will be, and if it's below the threshold, then they would waive the IRMAA surcharge and you would just pay the base premium. Now they will, catch that up on your tax return. So if you happen to, have more income than you thought and you go over those thresholds, they would, apply it when you file your taxes. The income thresholds to those, so these were these brackets similar to the provisional income brackets on Social Security for the longest time weren't changing, but now they are, they do increase based on a automatic escalator, like the cost of living increase that you see in Social Security. Congress doesn't need to pass anything to actually increase these every year based on that escalator. So once you hit that first threshold, and this is per person that's on Medicare within the household. So if there's two people married filing jointly and you're both on Medicare and your income joint, MAGI, is over 212 but under 266,000, and again, this is in 2023, you're going to pay an extra $74 per person per month for the year for your Part B, and an extra $13.70 per person per month for your Part D for the year. And then this resets every single year. So they're looking now in 2026 when that comes up. Again, you get notification in Q4 of the previous year of what your next year's Medicare premiums will be based on, again, 2-year prior tax returns. And you can see as your income goes up, single filers and married filers, how much additional you pay for your Medicare premiums. This is also something that I could see apply to Social Security. As your income goes up, maybe they, apply a different tax to your Social Security as well. But we'll see how that all shakes out throughout the year as the administration and Congress get together and talk about some of the tax bills that they're going to pass or look to pass. Let's talk about taxes here real quick. Here are the tax brackets. So these are the 7 different brackets. These are set to change in 2026. So these were slightly higher in 2016, and then in 2017, passing of the Tax Cuts and Jobs Act kind of adjusted these down. The 10% stayed the same, and then most of the other ones went down, anywhere from 1 to 4%, I believe. And those would be set to revert at the end of this year if Congress does nothing. Highly likely that this will at least continue, because this was passed under President Trump's first administration, and the makeup of Congress kind of looks like this would continue. We'll see how that shakes out throughout the year. You also have standard deductions. Those increase every year. So this is the amount of income that you receive tax-free, just comes right off the top of your tax return. Married filing jointly, $30,000. Single filers, $15,000. If you're over 65 and you're claiming the standard deduction, there's an additional amount for each person that's over 65 on the tax return. If you have certain expenses such as mortgage interest, charitable donations, State and local taxes, they're currently capped at $10,000. Again, that's another thing that could change. Administration talked about lifting that cap. If those add up to over the standard deduction, then you use what's called the itemized deduction, because those expenses allow you to have more of your income tax-free. Long-term capital gains and qualified dividends, they receive preferential treatment. So short-term capital gains, well, that applies to investments that are held outside of retirement accounts, tax-free or tax-deferred retirement accounts like Roth IRAs or traditional IRAs. So these are investments outside of that increase in value, and you liquidate the investment. Well, if you've held it for less than 1 year, that's subject to ordinary income. So the tax brackets I showed on the previous page, that just gets added as if, ordinary income. If you hold it for 1 year and 1 day, then you receive long-term capital gains, which you can see the thresholds here. If you're basically in the first 2 tax brackets, then you have no tax on your long-term capital gains or qualified dividends up to the point you cross over that second tax bracket. Once you cross over that, it's not a cliff, it's just the additional dividends, qualified dividends, or capital gains, long-term capital gains are taxed at 15%. You can see, and then if your income's even higher than the next threshold, they're taxed at 20% when it's over this amount. So you guys see how that comes into play here. Now I'm going to cover the Secure Act 2.0, and this is some of the changes that have been put into place when the Secure Act 2.0 was passed, and this was passed a couple of years ago, but they've been phasing in some of these changes, and I think it's good to kind of refresh everybody of what the changes have been, and then also what the future changes are that are being phased in. So here we have required minimum distribution. So that is the age at which you have to start taking distributions out of your traditional IRA. This does not apply to Roth IRAs and or 401ks if you're not employed at that employer anymore. If you're still employed, they waive the RMD as long as you're working for that 401k up until the point you retire and you're at that RMD age. So this changed with the Secure Act 1.0. It was 70 and a half for the longest time. That was the age at which you have to take distributions, and it was the year you turned 70 and a half. So it didn't matter when you turned 70 and a half. It's just the year that you turned 70 and a half. And what the RMD is, it's a formula. It's there's a life expectancy table that's published by the IRS, and they determine how much needs to come out of the IRA every year based on the previous year's ending balance. So for January 1, 2025, we know what the required minimum distributions for all of our clients that are subject to RMDs, what they are for the year. And then you have the entire year to take it out. It's just the rule is you have to take it out by December 31st. They don't care when you take it out, how you take it out, monthly, quarterly, one lump sum, does not matter, just as long as it comes out by 12/31. Well, passing of the Secure Act 1.0, they changed it from 70 and a half to 72. And then in Secure Act 2.0, they've now changed it from 72 to 73 for those who have a birth year between 1951 and 1959. And then for those that have a birth year in 1960 or later, then RMD age is now 75. And probably not the last time we're going to talk about changes to the RMD age. For, again, the longest time of 70 and a half, and now they've kind of been playing with that. This doesn't, couple of things regarding this. This doesn't change the age at which you can take qualified charitable distributions. That's what QCD stands for. So a QCD applies to your, again, your traditional IRA. And if you send funds directly from your IRA to a qualified charity, that's churches, pretty much most, organizations that, call themselves a charity or a church, then that does not count as income. But you have to be 70 and a half. You have to actually have crossed the 70 and a half age. So, it's got to be careful of that. It's not the year you turn 70 and a half, but you actually have to be 70 and a half, 70.5 or older. And the money has to go directly from the IRA to the charity. Cannot go to you first and then you turn around and give it to the charity. That would not apply. That's still, again, it's still 70 and a half. And then the other kind of piece to the QCD is that once you reach RMD age, those QCDs also count towards the RMD. So for example, let's say a very large traditional IRA and your RMD is $100,000 and you want to write a check to your alma mater for $50,000. Well, if you take that directly out of your IRA, that would apply, doesn't count as income. So that's a benefit there. And then also it would reduce your RMD by that amount. So then you only have to now take out $50,000 because your RMD is 100. 50,000 of the went towards the charity, the QCD, and then the other 50 you have to take out. So that's how that works when it comes to those qualified charitable distributions. Again, we do a whole webinar on tax planning and kind of talk about how to utilize these tax tools for charitable contributions. Oh, let me go back here. The other thing, I think the reason why Congress is they're able to justify increasing the RMD age is because most IRA owners are already using their retirement accounts to generate income. So they're eclipsing the required minimum amount. So this is not in addition. So it's like if you're taking out distributions out of your IRA and your RMD is 100,000, but you're taking out 120,000, well, then you've satisfied it. You don't have to take out anything more. And that's how it is for most people. So, they're not, when they increase the age, it's not necessarily changing a lot of things for many individuals. Now, one thing that it does do is that when you have different types of accounts, such as Roth IRAs, taxable like brokerage accounts, traditional IRAs, well, that required minimum distribution, by increasing the age, it does allow us from a tax planning standpoint to utilize different tax tools up until you hit that point to when you have those required distributions. Let's talk about Roth accounts. So for individuals that participate in a simple IRA or a SEP IRA, there's now Roth option associated with that. And then your employer contributions are eligible for Roth treatment. So that does, it is kind of on an employer by employer basis, but they can designate that now. That if you do select that, if you're able to select that, then the contribution that the employer gives you, if it's put into the Roth portion of your retirement account, it would be applied to your gross income. So you would have, tax that you owe on that because you're paying the tax today for the future benefit of no tax on anything in the Roth IRA. And it only applies to what they call non-elective or matching contributions. So if you receive profit sharing, which is, it's kind of all from the employer, but it's just designated slightly different in terms of how they calculate all these different things with ERISA and the Department of Labor and everything that goes involved in these retirement accounts and in retirement plans. Profit sharing does not apply. It's just the matching and non-elective. Roth accounts also, this started in 2024. If you have a Roth 401k, so those have been around for some time, most employers do have that option where you can contribute pre-tax dollars or after-tax dollars. And now this Roth, you can put money in the Roth. Up until 2024, if you separated employment and you left your money in your 401k and then you reached RMD age, Well, you'd have an RMD on your pre-tax money for your former employer's 401k plan, but you would also have to take an RMD for the Roth because they didn't have a rule that said you didn't have to. So you would have to actually take distributions from your Roth 401k. So in those situations, what most folks would do is they'd roll the money to an IRA, and by taking that money out of the 401k, you can now separate the pre-tax money and the Roth money into separate accounts and not worry about that. They adjusted that. So starting in 2024, if you have a Roth 401k and you've separated service, you're not subject to RMDs anymore for your Roth account. The other thing in 2024 is that if you're considered a high wage earner, and they have the definition here, you're required to utilize the Roth option for catch-up contributions. So what that means is that if the wages from the plan sponsor in the prior year are greater than $145,000, catch-up contributions have to go into the Roth account. And it applies to all the different basically types of retirement accounts except for IRAs and simple IRAs. And if they don't have a Roth option, then catch-up contributions are not allowed. So, a little nuance there regarding catch-up contributions. There's some changes to that too, which I'll have in a few slides in terms of how they calculate catch-up contributions now going forward. Also effective in 2024 is this ability to transfer money from a 529 to a Roth IRA. So this was put into place because people were diligent, saved for future education expenses via these 529 accounts, and not everyone needed to use all of the money in the 529 plan. And the way the 529 plan works is if you put money in, it grows tax-free. You don't really get a tax deduction. I mean, you get a state tax deduction, and each state is slightly different in terms of how they calculate it, but it's pretty minimal for most people. It's not really about a current tax deduction. It's more so about the growth, tax-free growth going forward. And if it was used for what they call qualified education expenses, which originally was just for a college, they've now kind of expanded the definition. It's pretty much any education that you have to pay for. Then you can take distributions from the 529 plan tax-free. However, if you had more money in there than the student needed, and now you have money in this account, well, if you took it out and it's not used for qualified education expenses, you are subject to the tax on the growth and a 10% penalty. So that just people, because of that, just left the money in the account, and they feel like the money's just stuck because what are we using it for? You can transfer it to as part of your estate plan, there would be a beneficiary, so it can continue to transfer to someone else in the future. So there is that option, but they came up with this ability to transfer 529 funds to a Roth IRA as part of the Secure Act 2.0. So how does that work? So you can move money from the 529 plan to a Roth IRA, but it has to be the same beneficiary. So if you have your 529 set up for your child, then the Roth, the money that would go to the Roth, would have to be in the Roth for the child. If you set up a 529 plan in the name of a child, you can change it to whoever you want. So you can also change it. You can change it to yourself, and then you could put the contributions into your Roth IRA as well. You do have to have earned income, though, for this to apply. So the child has to have W-2 or self-employment income at least equal to the amount transferred each year. And this is subject to whatever the Roth contribution limits are on an annual basis. So this is like considered making a contribution to a Roth IRA. You also have to have had the 529 plan open for at least 15 years. So this is for funds that have been there for quite some time. It's not something where you can put money into the 529 and then, within a year start transferring it to a Roth IRA. That does not apply. You have to have it in there for at least 15 years. And any of those contributions that were made within the last 5 years and earnings on those are ineligible. So, they would segregate it out. So it would just be the ones that apply that are prior to that if you've made contributions within the last 5 years, but also have older contributions in there. And then also, as I mentioned, you have to have earned income. It's basically subject to those IRA contribution limits every year. And then there's a maximum lifetime that amount that you can transfer, and that is $35,000. So once you hit that amount, you cannot move any more money into a Roth IRA. You also can use a portion of your 529 account to pay for student loans. It's up to $10,000 to pay for student loans. And yeah, as part of the Tax Cuts and Jobs Act of 2017, they broadened the use of 529 plans to cover private, K through 12 education. So expanded the definition there, or the ability to use 529s for more than just college education. Surviving spouses too have, some unique rules as part of the Secure Act. Because what happened in the passing of the Secure Act 1.0, when the government changed required minimum distribution age from 70.5 to 72, the other thing that they did was they changed the way, or the distribution schedule, that non-spouse beneficiaries, how that applies to them when they inherit an IRA. And this applies to traditional IRA, Roth IRA, 401k. It all applies, it's the same. What they did is they said, the prior rule was that you could stretch the distributions out over your lifetime if you were a non-spouse beneficiary. So for example, most commonly would be a child. So child inherits an IRA, they're 50 years old, they're forced to, this stretch IRA rule says they have to take out a minimum amount each year, but it's based on their life expectancy, and they could just stretch out that IRA over their lifetime. They could always take more. There's no early distribution penalty on inherited IRAs, but they could, essentially kind of treat a retirement account as their own retirement account, with this little nuance on the required minimum distributions. So with the passing of the Secure Act 1.0, they changed that, and they basically said IRAs aren't really designed to be retirement planning tools for the next generation. They're for the current savers. So we're gonna remove this lifetime stretch, and we're gonna tell everyone that they have to take distribution, the entire account, out within 10 years. So instead of stretching it out over a lifetime, they have a 10-year window now to take distributions. But then they said, well, there's some situations where we still want, or the old rules to apply, and this applies to surviving spouses. So they did not change the old rules. So this, basically still kind of how this works. But when a person dies and their spouse is the primary beneficiary, then when they inherit the money, there's a couple of ways they can inherit this. So they can, if the spouse has their own IRA, they can just transfer the money. If they don't have their own IRA, essentially they can just treat it as their own. So these first two bullet points are essentially the same. It's just kind of a nuance on how, functionally that comes together. But it's like, just they elect it to be their own IRA. And when it becomes your IRA, it's not an inherited IRA, so it's not subject to the stretch IRA rules or anything like that. But the other option is they can remain, they can also elect to have it treated as inherited IRA, but with special treatment. And electing it to be an inherited IRA, that would be for situations when a surviving spouse is under 59.5. Because if they elect to receive it as their own, well, then they're now subject to the early withdrawal rules, which means that there's a 10% penalty for any early withdrawals under 59.5. If they elect to receive it as an inherited IRA, they have to take required minimum distributions based on their age, but they aren't subject to the early 10% penalty. And another nuance with this is that once they reach 59 and a half, then they can essentially remove the inherited IRA status and then transfer it as if it was their own. So, the IRS and Congress is looking to make sure that surviving spouses are treated well when it comes to the situation with inherited IRAs. The surviving spouse required minimum distribution, they can also make an election to delay the RMDs until the age at which the deceased spouse would have had to begin taking them. What that means is that if the deceased spouse was younger, well, then they can even wait even longer to take required minimum distributions. This is just how that's calculated. There's two tables, uniform lifetime table or the single lifetime table. And, the uniform lifetime table is just slightly smaller required distribution than the single lifetime. So they would allow that for surviving spouses. And then, the beneficiaries of surviving spouse IRAs, well, then, they wouldn't be able to, stretch it out like the surviving spouses. They'd be subject to the 10-year rule, just like everyone else. Let's talk about catch-up contributions. This went into play in 2024. So the IRA catch-up contribution limit, it's $1,000, which had been in place for 15 years. So now they're going to index it for inflation in $100 increments, meaning if the inflation adjustment's less than $100, then they're not going to increase it. It's only when it eclipses $100 will they increase it. And again, the high wage earners would be subject to the Rothification of their catch-up contributions. And then in 2025, there's some kind of calculations that are slightly different to catch-up contribution. So that's now effective this year. And the way this works is that catch-up contribution limit, and this is for people between the ages of 60 to 63, is $10,000 or the greater of 150% of the regular catch-up contribution. Well, the standard contribution is $7,500 in 2025. So 150% of that in 2025 would be $11,250. So if you're between age 60 and 63, your catch-up contribution is increased up to $11,250 should you want to put that additional amount in there. So this is kind of a visual on how this works. So, under age 50, there's no catch-up contribution. Age 50 to 59, the standard catch-up contribution in 2025 is $7,500. So that's in addition to the 401k limits that everyone else, has access to. Then they have this enhanced for 4 years. You can put in, that formula I said, greater of $10,000 or 150% of $7,500, which is $11,250. And then after once you turn age 64, then it goes back down. I don't know why they, made it so complicated, but this is what Congress does. Some additional changes here. Those qualified charitable distributions, those are now indexed for inflation. So as I mentioned, when you're 70 and a half and you have an IRA, especially a traditional IRA, you can take distributions and send them directly to a charity, and that does not count as income. And then once you actually have to take required minimum distributions, that also counts towards your required minimum distribution as well. It was $100,000, once they kind of put this in place for quite some time. Now it's indexed for inflation, so the amount will go up slightly each year, and I believe it's $106,000 is the amount of QCD for 2025. There's also the ability to take penalty-free withdrawals to fund long-term care. So this goes into play here at the end of this year. The withdrawals allowed up to the lesser of 10% of your vested balance in the plan, or $2,500 annually, which is indexed for inflation. So if you have long-term care insurance, premiums, you can take penalty-free withdrawals. We would advise people if they have funds outside of their, there probably would make sense to take that out. But again, it's kind of unique to every individual. They also had some adjustments to the 72T, which for those that aren't familiar, that is the tax code that basically says you can avoid the 10% early withdrawal penalty for distributions from your IRA prior to age 59 and a half if you follow certain rules. And essentially what those rules are is that you have to take what they call equal payments out of your IRA. So there's, once you begin this, you have to do it for at least 5 years, and it's a formula that the government provides based on current interest rates and your account balances and things. And you have to do that for at least 5 years or until you're 59 and a half, whichever is longer. So if you start this at age 58, you have to do it for 5 years. If you started at age 50, you have to do it until you're 59 and a half. Once you reach 59 and a half or the 5-year period, you can then, take out as much as you want, not have the 10% early withdrawal penalty anymore. But they allowed this for people that were younger that had, good account balances and wanted to retire, but, they weren't because of this 10% penalty. They clarified some things, so you can transfer money in and out of these accounts. Prior to that, it was more of a question, I think, that could you do that or not, as long as you were taking out the same dollar amount. It doesn't necessarily change what you're taking out, it's just what's the account balance. And people felt that they were stuck at certain institutions or things like that because they had the 72T and they didn't want to move it because they were afraid they'd get in trouble for just moving it as well. The penalty for missed RMDs has also been adjusted, so effective in 2023. If you forgot to take your RMD, the IRS said that the penalty was 50% of the amount that you were supposed to take out. It's a pretty hefty penalty. So basically, they were saying, don't forget to do this. Well, they've now reduced it to 25% and even further reduced to 10% if you fixed it during what they deem the correction window. And, the way that that's been interpreted is that if you determine that you forgot to take your RMD, and once you realize that, you reach out to your IRA custodian and you take a distribution out and satisfy the amount that you forgot to take out. And that was prior to the IRS notifying you. So essentially, it's basically the correction window is like they send you a deficiency letter saying, hey, you forgot to do this. The tax, when the tax is assessed, or the last day of the second year after the tax is imposed. So they give you, quite some time to figure it out and fix it on your own. And they would apply a 10% penalty if you do it in that window. If you wait until them to tell you, well, then the penalty is increased to 25%. This is a little bit more on those rules regarding inherited IRAs. So back, as I mentioned prior to the Secure Act 1.0, eliminated this death of the stretch IRA. So your non-spouse beneficiaries, they have 10 years to take out the distributions, and that includes Roth IRAs too. So there's some planning that now kind of goes into play around this, because with a 10-year window, that could be, especially with folks with large IRAs, that could be a lot of money for the beneficiaries. And if they're still working, that could be, a lot of tax they have to pay. So part of what we evaluate on an annual basis is like, let's look at even you as the current IRA owner. Maybe you convert money to a Roth IRA because you're in a lower tax bracket than your beneficiaries will be in the future. There's some unknowns there, but we're just looking at how do we take advantage of the current tax code and pay the least amount of lifetime taxes that we have to, and even looking further, less taxes for your children if that's important to you. Now, they do have some exceptions to this rule. So, I mentioned non-spouse beneficiaries. Well, that would be an exception would be surviving spouses. So they have their own rules, as I mentioned. But also, if one of the beneficiaries, I mean, you can have multiple beneficiaries, and they, some of them might have the 10-year window and some of them may not. It's just each individual beneficiary is going to have their own rules based on their situation. If you're considered disabled or chronically ill, then they allow you to stretch out the RMDs over your lifetime if the beneficiary is not more than 10 years younger than the original owner. So, for example, this would be most commonly is like, let's say you name a sibling as your IRA beneficiary and they're 2 years younger than you. Well, then they're not subject to the 10-year window. They have the RMD or the stretch IRA rules as previous. And then the last one is minor children. So if you have young children, let's say a 10-year-old is listed, or even if it's a grandchild, and they inherit a portion of your IRA, then they have to take distributions based on their life expectancy up until they hit the age of majority, which is different for each state. So in Missouri and Kansas, it's 18, I believe. And so once they reach age 18, then the 10-year clock starts. So just something to be aware of when it comes to naming your beneficiaries. I know I talked a ton here. We covered a lot of material, and this is designed to just provide information, especially as useful as we can around how these rules change, but every person's situation is going to be different. So, I encourage you, I mean, if you're a client of Keen Wealth, we're covering all this for you as part of our review process, and throughout the year as we're looking at your situation and doing our tax planning and everything else, we're looking at all this to make sure that maximizing what you have and having those conversations for those that are not clients of Keen Wealth. I mean, again, there's a lot to consider, and if you haven't sat down with a fiduciary financial planner such as Keen Wealth, I encourage you to do so and go through this. I mean, we have a team here of CFPs that are more than able to go through this process with you. And this applies to clients too. If you have friends, family members, colleagues, and you want us to have a conversation with them, happy to do that and see if there's a way that we can help them. I'm happy to answer any questions that people have. I appreciate those that had submitted questions ahead of time. That definitely helps shape some of the material. And for those that submitted questions throughout today's presentation, we'll make sure to get those covered for you in a future podcast episode. That's typically what we do with those questions that we weren't able to cover, is we'll cover them in future podcast episodes, because we find that many people have maybe the same question, so want to make sure that we cover that. Again, reach out to us if you'd like to sit down and go through all of these different things. There's probably a few things that apply to each individual. Not everything applies, but also how do you make decisions in the context of your overall financial picture? It's hard to do that without certain tools in place to understand, especially when it comes to tax planning. Like, hey, if I do this, well, what impact does that have on my other income? There's kind of a lot of nuance with that. Again, check us out if you're not subscribed to our blog and podcast, keenwealthadvisors.com, and check out Retirement Resources. If you'd like a copy of the book, to send us a note and we will get that sent out to you at our expense. Happy to do that. And lastly, check out our YouTube channel where you get to watch us talk in person. Some people enjoy, I guess, seeing our faces on their computer screen or mobile device. Again, thank you all for joining today's webinar, and we will see you next month.